Many people go through life without ever learning how to manage their money, which leads to financial struggles down the road. The unfortunate reality is that financial education is often overlooked in schools, and most families don't teach their children about money because they themselves never learned how to handle it. What's even more frustrating is that discussing money openly is still considered taboo. But here's the thing, creating wealth isn't as complicated as it seems. If you can learn the basics, turning $100 into $1,000, $1,000 into $10,000, and even $10,000 into $100,000, completely achievable. Here's something inspiring. 80% of millionaires come from middle or lower income families. This shows that building wealth isn't just for the rich. It's something anyone can do, as long as they know the right strategies. To make this easier for you, I'm going to share a step-by-step guide to building wealth. You'll learn the blueprint that the wealthy follow, how to find the best returns on your investments, and exactly where I'm putting my money over the next 10 to 20 years. I practice what I preach, and I'm confident this approach will work for you too. By the way, if you're finding this video helpful and want more content like this, comment more below. Let's keep going. Before we dive into the details, let's first get back to the basics. No matter who you are or what you do, everyone focuses on one thing when it comes to managing their money: cash. The reality is that most people don't really know where their money's going. They're aware of how much they have in their bank account or on their credit card, and they think that's what they can spend. When their balance gets low, they cut back until the next paycheck arrives and the cycle continues. But that's not how wealthy people manage their money. If you want to start building wealth, you need to first focus on cash management. The best way to do this is by tracking your spending for at least the next 60 days. You can use apps like Rocket Money, You Need a Budget, Every Dollar, Monarch Money, or even just an Excel sheet. Record every penny that comes in and goes out of your account. This will help you spot any unnecessary spending, impulse purchases, or areas where you're spending too much. Things you could either negotiate for cheaper or avoid altogether. By cutting back on these expenses, you could save an extra 10% to 15%. It's similar to a diet. Once you track what you're doing, it becomes easier to make improvements. Right now is the best time in the last 20 years to make your money work for you. High-yield savings accounts are paying at least 4%, and with some effort, you can earn even more, 5% or higher. For example, Synchrony Bank is currently offering 4.5%, and Wealthfront is offering 5%. Robinhood Gold members also get 5%. Personally, I allocate about 20% of my investments into a mix of high-yield savings accounts, money market funds, and treasuries, where I'm currently earning over 5%. This portion of my portfolio is my security fund, providing me peace of mind knowing I have reliable cash reserves, no matter what happens with my other investments or the economy. Plus, it's earning solid returns while I don't have to actively manage it. Once you've saved up some cash, it's time to focus on paying off high-interest debt. Debt has become a huge problem for many people, and the numbers show it. The average American now owes over $22,000, mostly from credit cards, car loans, and personal loans. With current interest rates, if you don't actively work on paying down your debt, you could be losing out on a lot of money, potentially thousands or even tens of thousands of dollars each year. Here's how I handle debt. If the interest rate on my debt is higher than what I can earn from my investments, I make paying off that debt a priority. If the interest rate is lower, I'll pay it off more slowly and invest the extra money instead. To decide how to handle your debt, ask yourself, is there any way I can earn a risk-free, guaranteed return that's higher than the interest rate I'm paying? If the answer is no, then focus on paying off the debt. If you want to pay it off faster, there are two strategies that can help you get it done more quickly. The first method for paying off debt is called the avalanche method, and it's the most efficient when you look at it from a math perspective. With this method, you focus on paying off the debt with the highest interest rate first. This is the debt that's costing you the most money. Once that's paid off, you move on to the next highest interest rate and keep going until all your debt is paid. The second method is called the snowball method, and it takes more of a psychological approach. Instead of focusing on the interest rate, you pay off the debt with the smallest balance first. Once that's gone, you move on to the next smallest balance, and so on. The reason this method works so well is that paying off smaller debts gives you a sense of achievement. It boosts your motivation to keep going and tackle bigger debts. Both methods are effective, so choose whichever one works best for you and stick with it. Now let's talk about investing. If you're just starting out, consider opening a Roth IRA. With a Roth IRA, you can contribute up to $6,500 each year. By the time you're 59 and a half, all the profits you make within the account are completely tax-free. Plus, you can withdraw the money you've contributed at any time, without any penalties. If you make under $138,000 a year as a single person, this is one of the best ways to build wealth efficiently. Here's an example. Let's say you just focus on maxing out your Roth IRA each year with $6,500. If you start when you're 20 and keep doing this until you're 65, assuming you get an average return of 7% from the stock market, you'd end up with about $2.5 million by the time you retire. And the best part? You wouldn't owe a penny to the IRS. The best time to start contributing to a Roth IRA is when you're young, especially if you're not earning a lot of money. This is because when you're in a lower tax bracket, you pay fewer taxes, which leaves you with more after-tax income to invest. Additionally, starting early gives your money decades to grow. The power of compound interest means that even small contributions can grow significantly over time. When it comes to opening a Roth IRA, most brokerages offer them, and setting one up is quick and easy, usually taking just 10 to 20 minutes. The choice of where to open your account largely depends on personal preference. However, the most important factor in growing your wealth is choosing the right investments. While the process of investing itself is relatively simple, many people struggle to stick to it, often getting distracted by the desire to make quick money rather than focusing on steady, long-term growth. If you want to build wealth over the long term, here's a simple blueprint most people can follow. First, stick with index funds. A few years ago, Warren Buffett famously recommended index funds as the best investment for most people, and I agree. Index funds are collections of stocks from various companies and industries, meaning they're highly diversified, which reduces risk. They're also very affordable to own. For example, Fidelity offers index funds with no fees that track a wide range of markets. I personally invest in index funds too. My stock market portfolio is made up of just two funds, 80% S&P 500, the 500 largest companies in the US, and 20% international stocks. It's simple, stable, and effective. Second, diversify your investments. This means you should never put all your money into one stock, cryptocurrency, or asset. If you do, you risk losing a lot of money. For instance, tech stocks lost 78% during the dot-com bubble. Housing prices fell 50 to 70% in some areas during the 2008 crisis, and some cryptocurrencies dropped by as much as 99%. The key is to spread your money across different companies, industries, and types of investments. This way, if one investment goes down, you have others to protect your wealth. Third, don't try to beat the market. While it might be tempting to pick individual stocks or invest in high-risk assets hoping for big returns, most people fail at this. Even professional investors in hedge funds struggle to consistently outperform the market. Instead of trying to outsmart the market, just aim to track it. The simplest approach often works best, so focus on steady long-term growth. Fourth, practice dollar-cost averaging and don't panic. The most important part of investing is to keep investing regularly, dollar-cost averaging, and then leave your money alone for as long as possible. This is the hardest part for many people. If you sell your investments in a panic when the market drops, or stop investing because prices seem too high, you could miss out on huge gains when the market recovers. For example, if you sold your investments in March 2020 because you thought the market would keep falling, you would have missed the massive recovery that followed. Or if you sold at the peak because stocks seemed too expensive, you might have missed even higher returns. The truth is, studies consistently show that holding a well-diversified portfolio and sticking to a buy-and-hold strategy is the best way to grow your wealth over time. When it comes to returns, the S&P 500 has historically provided an average annual return of 10.6% over the last 100 years, including dividends. In more recent years, the average has been higher, around 13.4% over the last 14 years. However, it's important to note that these past returns don't guarantee the same results in the future. Your returns will depend on two main factors. 1. When you start investing, the timing of when you begin can have a big impact on how much money you make. 2. How long you invest. The longer you stay invested, the more likely you are to see positive returns, as the market tends to rise over time. For example, from March 2000 to March 2009, the S&P 500 had an average annual return of negative 5.2% due to the dot-com bubble burst in the Great Recession. But if you started investing in 1978 and kept going until 2000, you would have seen an average return of 17.4%. This shows that, historically, the S&P 500 has provided positive returns when looking at 20-year periods. However, the annual returns can vary widely, ranging from as low as 2% in the worst years to as high as 18% in the best years. While past performance gives us an idea, future returns could be very different. A recent study looked into whether we can expect another decade of extraordinary returns in the stock market. Over the past 10 years, investors have seen average annual returns of 12.8%, which is much higher than usual since 1950. This strong performance was largely driven by the Federal Reserve keeping interest rates very low, which pushed investors to put their money into stocks to earn better returns. On top of that, companies experienced strong growth, leading to record profits and stock prices. However, things have changed. Interest rates are now at their highest levels in decades. For the stock market to keep delivering the same level of returns, stock prices would need to rise dramatically, around 40% higher than the peak during the tech bubble in the late 90s. Additionally, to continue strong returns, companies would need to grow their earnings by about 6% each year, which is the best growth seen in normal times. This means we shouldn't expect the same high returns we've seen recently to continue forever. In fact, firms like Vanguard and Charles Schwab have lowered their return expectations for U.S. stocks in the next 10 years. Vanguard expects annualized returns of just 4.2 to 6.2%, and Charles Schwab predicts a 6.2% annual return for large U.S. companies. To put it simply, earning returns of 12 to 15% a year is not normal and is very difficult to sustain. Instead, it's better to expect more realistic, long-term returns of around 7 to 8%, which is what we've seen historically over the past several decades. Here's a breakdown of how I'm investing my money right now, and I hope this transparency can give you some insights into my strategy. Number 1, 30% residential real estate. These properties were purchased between 2012 and 2021 in different regions across the Midwest. Most of the homes needed some renovation, so I bought them at lower prices, fixed them up, and rented them out for a profit. All properties have long-term tenants with leases in place and are financed with 35-year fixed-rate mortgages at interest rates between 3.0% and 3.5%. This ensures stable, predictable monthly payments. The values of the properties have increased significantly, mainly due to the improvements made during the renovation process. Vacancies are rare and typically filled within a week. Maintenance and repairs have been minimal since the initial work was done, allowing for steady income with low ongoing expenses. This approach has been effective for generating consistent rental income and adding long-term value to my portfolio. Number 2, 5% private equity or startups. I've also invested a small portion in private equity or startup businesses. This could include early-stage companies or private investment funds. These types of investments are highly speculative, but they offer the potential for high returns if the business succeeds. I treat this as a high-risk, high-reward portion of my portfolio. This diversified approach gives me a balance of security, growth, and high-risk opportunities, helping to spread my investments across different types of assets to reduce risk while still having the chance for higher returns. Number 3, 20% cash and treasuries. This portion of my portfolio, 20%, is kept in cash and low-risk investments like high-yield savings accounts and money market funds, which currently earn between 5.2% and 5.3%. Although the stock market has performed well, I maintain this cash reserve for important needs such as business expenses, day-to-day living costs, real estate renovations, and unexpected emergencies. Having this liquidity ensures that I can cover any immediate financial obligations without needing to sell other investments. Number 4, 35% index funds. A significant portion of my portfolio, 35%, is invested in index funds with 70% allocated to the S&P 500 and 30% in international stocks. I follow a consistent buy and hold strategy, investing regularly in these funds no matter what the market is doing. This approach ensures my money continues to grow over time. I don't plan to withdraw from these funds for the next 25 to 35 years, which will allow the power of compounding to maximize returns. This method is straightforward, cost-effective, and provides broad exposure to both the U.S. stock market and international companies, making it a reliable strategy for long-term wealth creation. Number 5, alternative investments. This portion, making up 10% of my portfolio, includes a small allocation to Bitcoin and other higher-risk assets that I consider more speculative or fun. I'm aware that these investments are volatile, and I'm okay with the possibility that they could lose value entirely. The goal here isn't to rely on these assets for stability, but to potentially take advantage of significant upside if they perform well. Here's the key to building significant wealth over the long term. Stick to the basics. First, focus on boosting your income while keeping your expenses in check. This is your foundation. Next, make sure to pay off any high-interest debt as quickly as possible. The faster you clear this, the less money you lose to interest over time. Also, make use of retirement accounts that offer tax benefits like a Roth IRA or 401k. These can help your money grow faster with less tax impact. Don't forget to spread out your investments. A diversified portfolio helps protect you from market swings and gives you the best chance of long-term growth. Lastly, the key is consistency. Keep up with these habits for the long run, and you'll start to build a solid financial foundation. I know it may not seem as glamorous as some get-rich-quick schemes, but this is the most reliable way to build wealth. Stick with it, and these principles will still be relevant for years to come. If you found this helpful, don't forget to like, subscribe, and comment to help out the channel. Thanks for watching.